Ever wonder why that mysterious number, your credit score, has so much control over your life? Who decides how it's calculated? And why does it hold so much power? In this video, we are exploring the origins of credit scores and how they are calculated. But before we get into that, let's rewind. How did a simple number come to rule our financial lives? Let's take a step back to 1800s. Local merchants started sharing financial information about borrowers, creating a system that would eventually become the foundation of modern credit reporting. At this time, lenders were typically small, local businesses, think shopkeepers and community banks, who had personal relationships with their customers. They made lending decisions based on what they knew about individuals and their local reputation. However, by the early 1900s, as credit began to extend to everyday individuals, the landscape started to shift. Lenders grew in numbers and size, and decisions were often made based on limited information and subjective judgments. This system had some significant drawbacks. Let's break them down. First up, bias and discrimination. Credit decisions often relied on personal judgments, and let's be real, those were skewed by things like race and income. Second, inaccuracy and inconsistency. Lenders were all over the place with how they judge creditworthiness, leading to totally mixed decisions that left borrowers scratching their heads. Third, lack of transparency. Imagine not knowing why you were denied credit or how you could fix it. That was reality for many back then. And finally, limited access to credit. A lot of people were denied simply because they had little to no credit history. Talk about a catch 22. But then, in 1956, the real heroes came along. Enter Bill Fair and Earl Isaac. They founded Fair Isaac and Company. Yep, that's FICO. They introduced a statistical approach to credit scoring, trying to take the biases out of the picture. After launching their company, Fair and Isaac dove headfirst into developing statistical models to assess credit risk. They spent years researching credit behavior, cracking the code on what really predicts if someone would pay back their debts. By 1960s, they started working with financial institutions, testing their shiny new scoring models. Imagine running pilot programs that showed lenders, hey, you don't need to rely on gut instinct anymore. We have got the data to back this up. This caught the attention of banks and credit unions that were eager for a more reliable way to assess borrowers. Now, let's zoom into the 1970s. With the economy buzzing, more people wanted to access loans and credit cards. But there was a problem. Lenders needed better way to assess all these potential borrowers. Fair and Isaac's scoring model was gaining traction just in time. Even the federal government got involved. In 1970, the Fair Credit Reporting Act was passed, pushing for more transparency and fairness in lending. The act laid the groundwork for standardizing credit scoring, giving Fair and Isaac work a huge boost. Let's not forget 1981, when Fair Isaac introduced the first credit card specific scoring system. This allowed credit card issuers to assess applicants more objectively, paving the way for future developments. Now, let's jump to 1989. This is when FICO introduced the score we all know today. FICO score became a game changer, providing lenders with a consistent, reliable way to evaluate potential borrowers across the board, not just for credit cards, but also for mortgages, auto loans, and more. Major banks were among the first ones to adopt the FICO score. Today, the FICO score continues to evolve, playing a crucial role in credit decision making for millions of consumers worldwide. Not to be outdone, in 2006, the big three credit bureaus, Experian, Equifax, and TransUnion, joined forces to create VantageScore. This new scoring model aimed to provide a more consistent and reliable way to access credit risk across different lenders and industries. Unlike FICO, which mostly looked at traditional credit data, VantageScore considered extra stuff, like how you pay your rent and utilities. That meant it could help people with limited credit histories get a fair shot. It opened new doors for lenders, giving them another tool to assess borrowers. And as VantageScore gained traction, competition with FICO heated up, driving both to improve. Today, many lenders use both scores, which ultimately benefits you by offering a fairer, more accurate picture of your creditworthiness. Fast forward to today, and credit scores are everywhere. They impact everything from whether you get approved for a loan to what you pay for insurance. Yes, these scores are kind of a big deal. Now that we got the background, let's dive deeper into the two major players, FICO and VantageScore. What makes them different? Stick around as we break it down. First up, FICO. Established back in 1989, it has become the go to credit scoring model used by majority of lenders. On the other side, we have VantageScore, introduced in 2006 by the big three Experian, Equifax, and TransUnion. This scoring model was designed with inclusivity in mind, aiming to give more consumers access to credit. Both FICO and VantageScore share a score range of 300 to 850. It is universal language of credit scores. But how do they get there is where things get interesting. When it comes to usage, FICO dominates the traditional lending space. It's the score of choice of 90% of mortgage lenders and commonly used by credit card issuers. Meanwhile, VantageScore is gaining traction, especially among credit unions and smaller banks, along with growing popularity in the world of online lenders and fintech companies. Now let's talk scoring models. FICO has bureau specific models, which means you might see slightly different scores from each credit bureau. VantageScore, however, takes a more streamlined approach, where a single tri bureau model that applies across all three major credit bureaus. Well, that's easy. When it comes to minimum scoring requirements, FICO requires at least one account that's 6 months old with recent activity to generate a score. But VantageScore plays nice, allowing you to score with just one account, even if it's less than 6 months old. So if you're just starting your credit journey, VantageScore might have the edge. FICO also offers specialized scores for different industries, like the FICO Auto Score, catering specifically to auto loans. VantageScore, while having fewer specialized scores, is carving a niche in alternative lending sectors. Let's not forget about popular models. FICO's got the classic FICO Score 8 and the FICO Bank Card Score 8, while VantageScore shines in its VantageScore 3.0 and the latest VantageScore 4.0. Each has its strengths, appealing to different lenders and consumers. Finally, we have trends and adaptations. FICO is constantly updating its models to reflect changes in consumer behaviors and lending practices, with FICO Score 10 and the FICO Score 10T leading the charge. VantageScore is also evolving, with its 4.0 plus version incorporating trended data to give lenders a better picture of credit utilization over time. It's important to understand that these models used by major banks can impact your chances of getting approved for a credit card. Let's take a closer look at two banks, Bank A and Bank B. Bank A primarily uses FICO scores for their credit card approvals, often requiring a score of 700 or higher for their premium cards. So if your FICO score is 680, you could face a rejection because they set a higher bar for approval. In contrast, Bank B takes a mixed approach, using both FICO and VantageScore models. They may approve applicants with score as low as 580, making it easier for those with less than perfect credit to secure a card and start building their credit. So, there you have it. Bank A focus on FICO score can set a higher bar for approval, while Bank B's mixed approach gives more opportunities to applicants. Understanding how these scoring models influence your chances can help you make informed decisions on where to apply for your next credit card. Remember, your credit score isn't just a number, it's a key to your financial future. Thanks for tuning into the Credit Duck. If you found this information helpful, don't forget to like, subscribe, and share your thoughts in the comments below. Until next time, keep working towards those credit goals.